Should you get a reverse mortgage? You've probably heard mixed things. Some people say it's a great financial tool. Others say it's a terrible idea. The reality is it just truly depends. For some homeowners, this can completely change their financial situation for the better, and for others, it can be the wrong move entirely. So in this video, I'm going to show you exactly how it works, who it's actually for, and how to know if it makes sense in your situation. Let's address the elephant in the room. When most people hear reverse mortgage, they immediately think the bank's gonna take my house or I'm gonna lose everything. And I get that perception didn't come out of nowhere. But here's the reality. Reverse mortgages today are not a scam. They're heavily regulated, and for the right person, they can be an incredibly useful tool. Now that said, and this is important, they're not for everyone. If you don't understand how they work, or if they're used in the wrong situation, they can absolutely create problems. So instead of trying to sell you on the idea, what I'm going to do is break down clearly so you can decide if it actually makes sense for you and your situation. All right, so naturally the next question is, what's the catch? Because anytime something sounds like no monthly payments, people assume there has to be a downside, and that's a really fair question. So here's what you need to understand. This is still a loan. You are borrowing against your home equity. Instead of making monthly payments, the interest is added to the loan balance over time, so the balance does grow, and then that loan gets paid back when you sell the home, move out, or pass away. And just as important, you still have responsibilities for the property. You have to keep up with the taxes, the insurance, and maintain the home. Now here's the key protection. This is a non-recourse loan, which means you or your heirs will never owe more than the home is worth. So yes, there is a trade-off. You're accessing equity today, but you're using up some of that equity over time. The real question isn't, is there a catch? It's whether the trade-off makes sense for your situation. Now, before we go any further, I want to simplify this, because if you don't understand how this works at a basic level, everything else can get really confusing. So what I'm going to do is break down really simply what is a reverse mortgage. To put it simply, a reverse mortgage is a way for homeowners, typically 62 or older for FHA products and 55 or older for some other reverse options, to access equity at their home without having to sell or make a monthly mortgage payment. So instead of you making payments to the lender is giving you access to your equity. That comes as cash, a line of credit, monthly income, or a combination of all three. Now you still owe the home, you stay on title, and you're responsible for the taxes, insurance, and maintenance. Then the loan is repaid later when you sell the home, move out, or pass away. So at its core, this is just a way to turn your home equity into usable money while you're continuing to live in the home. What makes this different really comes down to one simple idea and direction. With a traditional mortgage, your loan balance goes down over time as you make payments. With a reverse mortgage, it just works in the opposite way. What you're doing is you're accessing your equity instead, so over time the loan balance can increase. And that's not because something is going wrong, it's simply because you're using your home equity while you live in the home. So instead of slowly paying your house off, you're strategically turning that equity into cash. So the real question isn't whether that's a good or a bad thing, it's when does it actually make sense for somebody. So now that you understand what a reverse mortgage actually is, the next question is, do you qualify? And the good news is qualification is actually pretty straightforward. First, you typically need to be at least 62 years old, although there are some proprietary programs that allow borrowers as young as 55. The home does need to be your primary residence, so this is designated for the home you live in, not an investment property. You also need to have a decent amount of equity in the home. You don't have to own it free and clear, but there does need to be enough value here that the program can work. From there, it's really about making sure the property meets basic guidelines and that you're able to continue covering things like property taxes and homeowners insurance. And finally, there's a short counseling session. This is a HUD-approved third party whose job is to make sure that you fully understand how the loan works before moving forward. So when you take a step back and look at it, for most homeowners who meet the age and equity requirements, this is very doable. Let's talk about a few situations where reverse mortgage can actually make sense for a lot of people. First, if you don't plan to move, this is a long-term strategy. The longer that you stay in the home, the more benefits tend to outweigh the cost of the reverse mortgage. Second, if your retirement income isn't quite enough, this is where reverse mortgage can really help. It can help supplement your income, eliminate a mortgage payment, or just give you more breathing room month to month. Third is health can play a role. If someone's dealing with health issues and just wants to make sure they can stay in their home comfortably, this can provide access to funds for care, home modifications, or just added financial flexibility. And fourth, if a lot of your retirement income is taxable, pulling money from things like IRAs or 401ks can create a tax burden, but a reverse mortgage proceeds are generally not taxable, so it can be a more efficient way to access your cash. Now, none of these on their own automatically means it's right for you, but if you find yourself checking a few of these boxes, it's definitely worth taking a closer look at how this could fit into your overall financial plan. Whether you're looking to eliminate your existing monthly mortgage payment, use the cash to pay down debt, or pay medical bills, your reverse mortgage may significantly help your monthly cash flow. You retain full ownership of your home, the bank doesn't own the home, and finally, there's no restrictions on how you can use the money. Now let's flip it, because there's absolutely situations where the reverse mortgage does not make any sense. First, if you plan to move in the near future, this is designed to be a long-term solution, and upfront costs mean it usually doesn't make sense for short stays. Second, if your primary goal is to pass your home to your heirs with as much equity as possible, because the loan balance is going to grow over time, it may reduce the equity left in your home. And third is if you're not comfortable with how the loan works. You should fully understand it and feel confident. It's not something that you want to go into unsure. And fourth, and this is one is critical, if you can't comfortably keep up with the property taxes, insurance, and maintenance, even though there's no mortgage payment, those obligations don't go away. So this isn't about pushing a product, it's about making sure it actually works for your situation. Now, there are some upfront costs and things that need to be paid off, like an existing mortgage, closing costs, or any liens on the property. Most of the time, those are simply built into the loan itself. The key thing to understand is this: those items will affect how much money is actually available to you. Now, when most people hear the term reverse mortgage, they immediately think of a few common concerns, and honestly, a lot of them come from outdated information or misunderstandings. So I'm going to quickly clear those things up. First, a lot of people think the bank owns your home, and that's not true. You remain the owner of your home the entire time. Your name stays on title just like a traditional mortgage. Second is a lot of people think you lose your house, and again, that's not accurate. As long as you continue to live in the home, keep up with the property taxes, insurance, and basic maintenance, you can stay there for the rest of your life. And third is a lot of people think your kids can inherit the debt. And this is a big one. Reverse mortgages are non-recourse loans, which means your heirs will never owe more than the home is worth. They can choose to keep the home by paying off the balance or simply sell it and keep any remaining equity. Now, a lot of people think that reverse mortgages are only for desperate people. That might have been the perception years ago, but today, many financially secure homeowners use a reverse mortgage as a planning tool to create liquidity, reduce risk, or improve cash flow in retirement. And finally, that reverse mortgages are a last resort. In reality, it's just one of many financial strategies. For the right person in the right situation, it can actually be a very proactive decision, not a reactive one. So before forming an opinion, it's important to understand how these actually work today, not how they were perceived 20 or 30 years ago. So one of the most important questions people have is what actually happens to the home when the last borrower passes away? And the first thing to understand is that the lender does not take ownership of the home. They don't get the house, they don't get the title, and they don't own the equity in any way. This is simply a loan just like any other mortgage with a lien against the property. So at that point, everything really comes down to one simple question. Do they want to keep the home or not? If the answer is yes, the family can refinance the loan and keep the property, or they can purchase it out for about 95% of its current value, even if the loan balance is higher than what it's worth. That's where the non-recourse protection comes in. If the answer is no, the home is typically sold and the loan is paid off, and any remaining equity goes to their heirs. And even if there's no equity, they can walk away with no financial liability. So when you really break this down, it's simple. The family keeps control, they have options, and they're protected from the downside risk. And that's what gives a lot of people peace of mind. So let's talk about the real downside, because this is a part a lot of people either don't fully understand or it doesn't get explained clearly. With a reverse mortgage, your loan balance grows over time. Why? Because instead of making monthly payments, the interest is being added to the loan each month. So as time goes on, the balance increases, and as a result, your equity decreases. That's what you're seeing in this chart. Now, here's an important piece of context. Historically, home values have increased over time, which means you can still have equity in the property. But, and this is important, that's not guaranteed. Real estate markets go through cycles. So the real key takeaway is this: you're trading some future equity for cash flow, flexibility, or eliminating a monthly payment today. For a lot of people, that trade-off makes a lot of sense. For others, it may not. And that's why this isn't a one-size-fits-all situation. It really comes down to your goals and your timeline. Now let's talk about the product options, because this is where people start to see how this can be tailored to their situation. At a high level, there are really two ways these can be structured. You have a fixed rate option and you have an adjustable rate option. The fixed option is straightforward. You receive the funds as a lump sum and the rate is predictable. The adjustable option is more flexible. That's where you get access to things like a line of credit, monthly payments, or a combination of both. And that flexibility is why most people tend to lean towards the adjustable option, but it really depends on your goals. Now, from there, you'll see a few different programs on the screen. The most common one is called a HECM. That's the Federally Insured Reverse Mortgage through the FHA. That program has built-in protections and standardized guidelines, which is why it's the most widely used. Then you have proprietary or private options like HomeSafe. These can allow for higher loan amounts, different structures, and sometimes lower upfront costs since there's no mortgage insurance like FHA. But here's the key. There isn't one best product. It's what puts you in the best position based on your goals. So instead of getting lost in all of the details here, what I'm going to do is show you how these actually play out in real world scenarios so you can see what might make the most sense depending on their situation that you're in. So at this point, you understand how it works. Now, the real question is, when does this actually make sense in real life? Because that's where most people get stuck. So instead of theory, let's walk through a couple of real world scenarios so you can see exactly how this plays out depending on someone's goals. So in this scenario, Sean is 68 and Kim is 67. Their home is worth about $1.5 million, and they still have a relatively small mortgage balance of $150,000. Their main goal isn't to pull out a bunch of extra cash. It's simply to simplify their financial situation. They want to eliminate their monthly mortgage payment and also pay off about $110,000 in credit card debt. So in a situation like this, a reverse mortgage can be used to pay off the existing mortgage and wipe out all of the high interest debt. Now, instead of juggling multiple payments every month, they've freed up a significant amount of cash flow. And that's the key here. This isn't about taking on new debt. It's about restructuring what they already have in a way that improves their cash flow and reduces financial stress. And for a lot of people, that's where it becomes incredibly practical. Now let's talk about a different scenario. This one is less about solving a problem today and more about planning for the future. Claire is 62, owns her home free and clear, and her home is worth about $750,000. She's not dealing with debt, and she's not in a financial bind, but she is trying to plan ahead. Her main goal is to age in place and have peace of mind knowing that she'll have access to funds later on if she needs them. So what she did is she looked at other options like insurance or pulling money out later, but those can be expensive or uncertain. So instead, we start looking at how her home equity can be used more strategically, not necessarily to take money today, but to create the flexibility for the future. And this is where reverse mortgages start to look very different. So let's walk you through what this could look like for her. Let's look at what she actually qualifies for. Based on her age and the value of her home, Claire is eligible for about $246,000. After closing costs of roughly $24,000, she has about $221,000 available to her. Now, here's where things get interesting. Instead of taking that money out today, she leaves it in a line of credit. And with a reverse mortgage, that unused line of credit doesn't just sit there. It actually grows over time. In this example, it's growing at a rate tied to the interest rate, which is around 6.6%. So what that means is her available funds can increase year after year without her having to reapply or qualify again. And yes, rates can change, but the key idea here is that the line of credit has the ability to grow over time, but interest is only calculated on the money you actually use, not the total line. Now let's fast forward and see what this could look like over time. By year 20, when Claire is 82, her home value has grown to about $1.6 million. Her loan balance is still relatively low, around $89,000, because she hasn't been pulling money out aggressively. But here's the key part. Her line has grown to over $800,000. So even though she didn't need the money early on, she now has access to a much larger pool of funds later in life when she's much more likely to actually need it. At the same time, she still has over $1.5 million in equity in her property. So this isn't a situation where the loan is eating up the house. In this example, both things are happening at once. Her available funds are growing and her home value is growing. And that's why this can be such a powerful planning tool. So instead of waiting until she needs the money later and hoping everything lines up, she's created a growing safety net over time. And that's the strategy that you can use with a reverse mortgage. So now let's compare this to another option she was considering, using a hybrid life insurance or long-term care policy. At age 62, the initial benefit actually looks pretty similar, about $300,000 with the insurance policy versus about $221,000 with the reverse mortgage line of credit. But here's where things start to separate. With the insurance policy, she has to pay about $7,100 per year in premiums, and that's every single year. Over time, that adds up to over $140,000 out of pocket. With the reverse mortgage, there are upfront costs around $24,000, but there's no ongoing monthly payments required. Now we fast forward to age 82, the insurance benefit is still $300,000, but the reverse mortgage line of credit has grown to over $800,000. So not only did she avoid over $140,000 in out-of-pocket premiums, she also ended up with significantly more available funds later in life. And that's really the key difference. One option requires continuous cash flow and stays relatively flat. The other uses an existing asset, her home, to create a growing pool of funds without monthly obligations. Now, that doesn't mean one is always better than the other, but it clearly shows how a reverse mortgage can be used as a planning tool, not just a last resort. And for someone like Claire who wants flexibility and peace of mind, it can be a very powerful option. Now, to be clear, insurance and reverse mortgage serve different purposes, and there are situations where insurance makes more sense, but this shows in the right situation, a reverse mortgage can be a very powerful planning tool. Now, at this point, you might be thinking this sounds interesting, but what are the safeguards? And that's a fair question because there's several protections built into these loans that most people do not know about. One of the biggest misconceptions about reverse mortgages is that they're risky or unregulated, but in reality, there are several built-in protections designed specifically for borrowers. We're going to break each one of these down individually so you fully understand how they work and why they matter. Now, one of the biggest misconceptions, and honestly, one of the biggest fears people have, is that a lot of people think, what happens if the loan balance grows and ends up higher than the home is actually worth? Here's the key. That risk does not fall on you or your family. Reverse mortgages are non-recourse loans, which means the home itself is only the collateral. So years down the road, the loan balance ends up higher than the home's value. FHA insurance covers the difference. Your heirs are not writing a check, and no one is coming after the assets. On the flip side, if there's equity left in the home, that still belongs to you and your family. So what this really does is put a ceiling on the risk. You're accessing your equity today without creating future liability for your family. And in most cases, when the last borrower passes, the home is simply sold, the loan is paid off like any other lien, and the remaining equity goes to their heirs. Now, one of the biggest protections built into reverse mortgage is something people don't expect. You're actually required to talk to a third-party counselor before moving forward. And this is a good thing. This isn't the lender, and it's not anyone involved in the transaction. They don't sell anything. They don't benefit from your decision. Their job is purely to educate you. They're going to walk you through how the loan works, the costs, your responsibilities, and just as importantly, the pros and the cons. They'll also go over the alternatives and help you figure out if this is actually a good idea for your situation or if it's not. And they're very clear about the obligations, things like continuing to pay your property taxes, insurance, and maintaining the home. The session is usually done over the phone or by video. It only takes about an hour or so, and at the end, you'll get a certificate that's required for you to be able to move forward. But really, this step exists for one reason: to make sure that you fully understand what you're doing, feel confident in your decision before you ever move ahead. Another protection has to do with spouses. In some cases, one spouse may not be listed as a borrower on a reverse mortgage. This is what's called a non-borrowing spouse. Now, years ago, that created some real concerns, but today there are protections in place. If the borrowing spouse passes away or moves out of the home, the non-borrowing spouse is not automatically forced to leave. As long as they continue to live in the home and keep up with the basic obligations like paying property taxes, maintaining insurance, and taking care of the home, they can remain there. So this helps protect a surviving spouse and allows them to stay in their home rather than being put in a difficult situation during an already stressful time. Now, there are some guidelines or requirements around this, so it's important to structure the loan correctly up front. But the key takeaway is this: there are built-in protections designed specifically to prevent spouses from losing their home. Another built-in protection, especially with adjustable rate reverse mortgages, is that there are limits on how much the interest rate can increase. So even though the rate can adjust over time, it's not unlimited. There are caps on how much the rate can go up in a given period of time and also over the life of the loan. So what that means for you is there is a level of predictability and protection even in a rising rate environment. Now, this doesn't eliminate interest or stop the balance from growing, but it does prevent things from getting out of control too quickly. And again, this is just one of several safeguards that are in place to protect borrowers. Now, before you move forward with something like this, I always tell people you need to take a step back and ask yourself a few questions. First, how long do you plan to stay in the home? Because a reverse mortgage is generally for a longer term strategy, if you think you may sell or move in a few years, this is probably not the right fit. Second, how are you actually going to use the money? Is it to eliminate a payment, create monthly cash flow, build a safety net, or something else? The strategy matters just as much as the product. And third, do you fully understand the obligations? Even though there's no required monthly mortgage payment, you still have responsibilities like paying the property taxes, insurance, and maintaining the home. And finally, what would your alternatives be? And this is a big one because a reverse mortgage might be the best solution, but it might not be. There could be other options depending on your situation. The goal here isn't to push you into something, it's to make sure that if you do move forward, it's the right decision for you based on your goals and your timeline. Now at this point, you might be thinking, okay, what's the next step actually look like? And it's pretty simple. We start by understanding your situation and what you're trying to accomplish. Then we look at the real numbers based on your home, your age, and your goals. And then from there, we can compare a few options side by side so you can actually see how this works in real life. And then the most important part, we decide if this is even worth moving forward with. Because again, this isn't a one-size-fits-all. Once I have your information, instead of guessing, we can actually map out what this looks like for you. Different options, different ways to receive the money, and how each one impacts you over time. So you're not making a decision based on theory, you're making it based on actual numbers. Before you make any decisions, it's important to know who you work with. And these are real clients I've helped with very similar situations. And if you notice a pattern, it's not just about getting a loan done, it's about clarity, communication, and actually understanding your options. That's the part most people don't get, and that's what I focus on. So if you're trying to figure out if this actually makes sense for your situation, the next step is simple. Just have a conversation. And again, this is not a sales call. It's a discovery conversation. We look at your situation. I'll talk through your goals and decide if this is something even worth exploring. If it is, then what I'm going to do is I'm going to walk you through real numbers and give you everything you need to review with your family or advisor. And if it's not the right fit, I'll tell you that too. My goal is just to help you get clarity so you can make the right decision. So if you want to have that conversation, you can reach out to me here. And even if you're just exploring, that's exactly what this is for. This is no pressure, no commitment, just clarity. You can go ahead and email me, text me, call me, set an appointment, whatever's easiest for you. I'm here to be able to help you out.